The best time to build real wealth in the stock market feels exactly like this. And I know what you're thinking. Here comes another guy telling me to stay the course and trust the process. I'm not going to do that because that advice, while technically not wrong, is missing everything that actually matters. Today, I'm going to show you with real data what the investors who actually build wealth do differently during moments exactly like this one. And one of these concepts genuinely changed how I think about money forever. Think about this for a second. If your favorite store put everything on 20% off tomorrow, you'd probably grab a cart. But when stocks drop 20%, most people drop their phones and start spiraling. That's the first thing worth understanding. The stock market is the only place in the world where people run away from a sale. Here's the separation you need to make. Price and value are not the same thing. When fear takes over, prices drop. But the underlying value of the companies you own, the real businesses, the cash flow, the products people are still buying, that often hasn't changed at all. In March 2020, the S&P 500 fell 34% in 33 days. Apple didn't lose a third of its business. Microsoft didn't either. The market was panicking, not calculating. And investors who kept buying through that panic were sitting on massive gains within 12 months. One more thing before we move on, and this is important, especially for beginners. You are not losing money when your portfolio is red. You only lock in a loss when you sell. A paper loss is temporary. Selling makes it permanent. Keep that in your back pocket. The 31 days that explain everything. But before we get into this, if you like more content like this, make sure you subscribe to the channel so you don't miss out on any future videos like this one, and I hope you enjoy the rest of this video. Here's a number that should change how you think about timing the market. A University of Michigan professor named H. Najat Sehun studied every single trading day from 1926 through 2024. That's 99 years of data. What he found is genuinely striking. The entire 25-year return from 2000 to 2024 earned in just 31 trading days. That is 0.5% of all trading days in that period. Miss those 31 days, and after 25 years of investing, you have essentially nothing to show for it. Now, here's where it gets even more important. Updated research from Hartford Funds shows that 76% of the market's best days happen during bear markets or the first 2 months of a bull market recovery. So if you're sitting in cash waiting for things to feel safer, you are almost certainly sitting out the exact moments that do most of the heavy lifting. And the nuance that most people miss, the best days and worst days cluster together. They happen in the same messy, volatile windows. You cannot pick the green days without sitting through the red ones. Which means the argument here is not be brave and hope for the best. It's that staying invested is the only realistic way to actually capture those returns. Trying to time your way in and out doesn't just risk being wrong once, it almost guarantees you'll be wrong on the days that matter most. Your most underrated tool, dollar cost averaging. If you've never heard that term, here's all it means. You invest the same amount of money on a regular schedule, every paycheck, every month, no matter what the market is doing. That's it. No predictions, no timing, no stress. Here's why it works so well during downturns. When prices drop, your fixed contribution automatically buys more shares. When prices recover, those extra shares are now worth more. You captured the discount without having to think about it. It's a mechanical advantage built into doing nothing different. The lost decade from 2000 to 2010 is the perfect example. If you put $10,000 in all at once at the start of the year 2000, 10 years later, you would have around $10,400, barely moved. But if you spread that same $10,000 across the decade as consistent monthly contributions, roughly $86 a month, you ended up with closer to $15,500. Same market, same total money, different behavior, very different result. The number quietly draining your account. Still with me? Good, because this one surprises people every single time. Over the 10 years through 2025, Only 21% of actively managed funds survived and actually beat their index peers after fees. That's from Morningstar's latest active-passive barometer. For large-cap U.S. funds specifically, the ones run by the most resourced managers on Wall Street, only 14% beat the S&P 500 over that same period, according to Spiva. The fee gap is where this gets painful. The average active fund charges around 0.59% per year. A broad index fund like VTI or VOO charges around 0.03 to 0.04%. That difference sounds negligible, but the SEC has modeled it out. $100,000 growing at 4% annually for 20 years with a 0.25% fee leaves you with $208,000. With a 1% fee, $179,000. That's $29,000 gone, not to your returns, to someone else's salary. To be fair, not all active funds are equally bad. Fixed income and real estate managers have meaningfully better track records. Around 43% of high-yield bond active funds beat their index over 10 years. The lesson isn't all active investing is evil. The lesson is know exactly what you own, know exactly what you're paying, and hold it to a higher standard than sounding sophisticated at a dinner party. The headlines are not your strategy. Here's a pattern worth knowing. The stock market has technically predicted 9 of the last 5 recessions, meaning fear shows up way more often than recessions actually do. 1998, 2011, 2015, 2018, 2022, all massive fear spikes. Most of them had no recession following. Yet, if you'd sat on the sidelines waiting for the all clear, you'd have missed serious returns every single time. There's a reason for this. Financial media is not in the business of making you wealthy. It's in the business of keeping you watching. Fear gets clicks. Uncertainty drives engagement. And that's fine. Just don't confuse their content with your investment strategy. When Goldman Sachs issues a recession warning, it's worth being informed. Acting on it is a different thing entirely. What the data actually shows is almost backwards from what feels intuitive. Research from T. Rowe Price found that when the VIX, the market's fear gauge, is elevated, forward 12-month returns are often above average. High fear has historically been one of the stronger signals for positive future returns, not a warning to exit. The practical filter here is one question: who benefits from this headline? If someone is trying to sell you gold, a newsletter, or a crash-proof portfolio right when the market dips, that is a sales pitch, not analysis. Action plan: what to actually do. So, here's what this looks like in practice, step by step. First, if you have automatic contributions going into a 401k or Roth IRA, you are already doing this right. Don't change anything. That consistency is the plan working exactly as intended. Second, stop checking your balance every day. Seriously, studies consistently show that investors who check their portfolios more frequently make worse decisions and feel worse doing it. Set a monthly or quarterly check-in and leave it alone between those times. Third, if you have extra cash that you genuinely won't need for at least 3 to 5 years, a down market is a reasonable time to deploy it. Not recklessly, not your emergency fund, but patient capital invested during fear is how the gap between average and wealthy investors gets created. Fourth, look up your fund's expense ratio right now. If it's above 0.5%, ask yourself what you are getting for that extra cost, because a broad index fund will likely beat it 80% of the time anyway and charge you 10 times less to do it. And fifth, write down your investment why before the next downturn hits. One paragraph. Why am I investing? When will I need this money? What's my plan when it drops 20%? That piece of paper is worth more than any indicator or prediction because it's the only thing that keeps you from making an emotional decision at exactly the wrong moment. Here's the one thing I want you to take from this. Downturns don't destroy wealth. Reacting to downturns do. The market has recovered from every single crash in its history, every war, every recession, every pandemic, every panic. The only investors who didn't recover were the ones who sold at the bottom and never got back in. This doesn't feel comfortable. It's not supposed to, but this is where the actual gap between average and great investors gets built, right here in the moments that feel the worst. And if you're wondering how the market recovers every time, you'll need to understand what happens to the money when the market crashes. So, if you want to know more about that, make sure you watch this video as well.